Let's get some analysis on this now with Stephen Nash from FIIG Securities in Sydney. Stephen, thanks for joining us this afternoon. Let's just start on the global issues, in particular that weak manufacturing data out of Europe overnight. We saw the September PMI survey for Europe coming in quite weak. What do you think that says about the ECB's recent minus 0.4% forecast for European economic contraction this year?
Look, if anything, expectations for growth are being lowered all the time. We've got continued contraction in the peripheral economies. The only hope for European growth is continued expansion in German production. So I suppose it indicates that expectations will be lowered even further, and I suppose that puts extra pressure on the ECB to think about further monetary easing next month.
Yeah. We saw Spain's bond auction overnight of 3- and 10-year bonds achieving a yield, or the 10-year bonds achieving a yield of 5.6%. So that's compared to 6.6% at the previous auction on August 2nd. So a big 1% fall. Were you surprised that we didn't see a little bit more reaction on the back of that, or has it just been priced in now?
Look, I think the market had rallied substantially and was able to maintain those levels into the auction, which is positive. It's good to see that Spain can get funding at much more reasonable levels. The ECB has engineered a lot of this by announcements to the market without actually intervening in any meaningful way at this point. The problem for Spain going forward is whether it acknowledges or accepts the need for external funding, and it's very difficult for the Spanish to do that because it means a lot of loss of control for them. So I think what's going on now is that they're going through the implications of what this will mean for them, and at some point they will accept that funding is required. If they don't, the market will test them again and we'll see yields quite substantially higher from where they are right now.
Yeah, I guess that's the concern at the moment. Just quickly moving to the US, Stephen, we saw the Philadelphia Fed Factory Index coming out overnight, rising from -7 to -2 in September. Were those results encouraging?
Look, I think they are. I think some of the data is a little bit inconsistent with other surveys. The Empire survey earlier in the month was a little bit on the weaker side. There are positive aspects in all of these surveys, but broadly they're indicating growth is proceeding, but not as much as the Fed really wants. We've had, again, a lot of discussion by various Fed members overnight indicating that they broadly agree with the actions of the Fed, and that the focus now is on building on recent gains in terms of the mortgage market, getting confidence up and reducing unemployment significantly. There has been some calls for even maintaining low rates until the unemployment rate gets below 5.5%. So the focus is really on employment now.
And just turning to domestically now, Stephen, there's been talk this week from a few different of the banks and economists that we could see 2 rate cuts before the end of the year, and one in October now as well as November. What are your thoughts on that?
Well, I think the minutes really changed the game in a lot of ways. I think the RBA itself is reluctant to ease at this point. They want more data on what's happening in the property market and other areas, and what the flow on is from the recent easings. However, I think the business leaders on the board are really asking for some accommodation, given the higher than expected Australian dollar and the impact that has on manufacturing. Not that the easing will really affect the level of the currency, but will ease the funding pressures on manufacturers at this very difficult time. Maybe a compromise might be one extra adjustment, which is really tagged on to the previous easings rather than a new series of easings. This could be seen as a completion of what they've already done. I think that could be a possibility. Also, the RBA said that recent liaison indicates that flow on from the carbon price is not significant, so maybe that gives them scope to go in the October meeting.
Does an easing bias from the RBA have implications for longer term bonds?
Well, typically if we have an easing bias, we get a contraction of the short end, the Australian short end to the US short end, and that typically brings in the longer term 10-year spreads. So that easing bias, I think, will bring our 10 years a little bit tighter to the US a long bond, which itself is a little bit cheap right now. So I imagine we've got some scope for a bit of a rally in our 10-year bond rate at this point.
And just finally, before you go, Stephen, I just want to ask you about the oil price. We've seen it plunge about, or at least 7% so far this week, although it did stabilise a bit overnight now. Has that been a bit of a relief for bond markets?
Look, I think in terms of inflation, that is a bit of a sigh of relief. It's also good for US growth. Oil's a little bit different from a lot of the other commodities given current tensions in the Middle East. The Saudis have opened up a little bit of production which is aiding that price depreciation, which is good to see, but those tensions are still there. Israelis are very concerned about developments in Iran, and I imagine that the scope for further weakness in the oil price is limited at this point.
Dr. Stephen Nash from FIIG Securities in Sydney, really appreciate your time this afternoon. Thanks a lot.
Thanks very much. Bye.